New York's pass-through entity tax can save creatives thousands by converting state taxes into federal deductions, but only if you set it up correctly. Today, we'll walk through exactly how New York's pass-through entity tax works, who should opt in, and the money-saving mistakes to avoid.
Your creative genius deserves the same precision behind the numbers.
Welcome to Let's Get Fiscal,
hosted by Anastasia, Myiesha, and Danielle,
part of the women-led team at Coterie Tax.
From smart tax moves to cash flow strategy,
we decode everything it takes to run a thriving creative business
so you can scale with confidence and sleep easy at night.
Press play and let's grow your business.
Okay, so what do you want to talk about today?
Today, we are going to talk about the New York pass-through entity tax.
Yeah.
Super fun.
So pass-through entity tax, we're kind of focusing on New York, but every state is going to have different rules. Mm-hmm. So you need to be very, very aware and research it because there are some very hard deadlines for a lot of these.
Yeah.
So, I guess, would you like to know what the pass-through entity tax is?
I was like, let me just start from the beginning. Let's just explain it. And it's always good.
So, when you have a pass-through entity, which is a partnership or an S corporation, they're called pass-through because the business itself doesn't pay any taxes. What it does is it gives you as an investor a K-1 that shows the income that the business earned. And then when you file your personal tax return, that K-1 is included as part of it. And then you pay the income tax as part of your personal return at whatever your marginal tax rate is instead of, like a C corporation pays the flat 21% and things like that. So you as an individual are the one that's paying the tax for the business, really.
Oh, okay.
So it all just kind of gets lumped together as you're filing the personal return, which again is why they call it a pass-through entity. So when that happens, we have this thing that came about because the SALT cap, the state and local income tax, was set to $10,000. So you have the standard deduction or you can itemize. So the standard deduction is basically a dollar amount of, we are not going to charge you any income tax on this amount because it's considered the basic needs to survive.
Gotcha.
And if you're able to show that what you're spending in certain categories is actually greater than the standard deduction, then you're able to do what's called itemize. And so in a lot of cases, especially like New York and New York City, your state income taxes are going to be a little bit higher. And then also property taxes are a little bit higher. So then that would be able to push you into a scenario where you would be able to itemize and take a deduction that's greater than that like automatic number that the IRS is going to give you under the standard deductions side. But once they drop that all the way down to $10,000, now it doesn't matter if you're paying the state of New York $50,000 in income taxes, you still only are able to claim $10,000 when you file your federal return. So there was a smidge of pushback.
Just a smidge.
Just a smidge. So, one of these things was identified basically looking at the wording of some of the tax law and things like that. And it was identified that if a pass-through entity was not required to pay any income taxes, but it did it voluntarily, you could claim it as a federal tax deduction.
Oh, okay.
And so there is a little bit of nuance because the pass-through entity can't directly pay for your personal income taxes. So really what it's doing is it's purchasing a credit dollar for dollar that gets applied to your tax return.
Oh, okay.
So because the business is doing that voluntarily, it's not required to, you're going to get a federal income tax deduction, which could be anywhere between, 20 and 35%. And when you think about it, you are already required to pay your state income taxes. So why don't you just do it this special way and save 20%, like minimum on that. So that's really what the focus of the pass-through entity tax is. New York also allows for it, both New York State and New York City, because you got to remember the business is going to have to pay the city tax if you're in one of the 5 boroughs. But it is very strict.
Yeah. Okay. So I guess when do you know you should even like do this? Like it should use this as like a tax strategy.
Right. So in the state of New York, if you would like to do the pass-through entity tax, you must make the election and request this status by March 15th of the current year.
Okay. Okay.
So in a lot of cases, I would say make the election. Because again, all of the income taxes that you would be paying under the pass-through entity tax strategy are taxes that you're going to be paying anyways. And so let's say maybe your income that year is really low. It's like $10,000. And, we're really looking at, maybe 9% of that is going to be eligible for the pass-through entity tax, and then you only get 20% of that. It may be a negligible number, but still, $40 is $40. You can go out to eat or something there. So that's why I say, especially because there is that very, very hard deadline, because creatives, the income can fluctuate pretty greatly. Yeah, it's better to just request that pass-through entity election, because, maybe things are not doing so well in the first quarter, which is pretty reasonable, especially in, like everybody's cold sitting inside. But you don't know what's going to happen in, October, something like that, and what kind of opportunities that you'll have at that point in time. So making sure that you're going on to the New York Department of Tax and Finance, their website, making the election, and doing that before March 15th is going to be super, super important, because once you get to March 16th, it's done. You are not eligible for this, and it doesn't matter, what you want to do. If you didn't make that election in time, you're not going to be eligible for it.
Okay. Okay, cool. And so you say that usually you suggest it, like go ahead and do it, because, even if it's $40, it's still like, $40 that you save later. Is there like a specific like income level someone should be at to like really, really consider to like even know if they should do it to do that saving thing? Do you know what I mean? Like, yeah.
It's the same thing with an S corporation, where it's not necessarily based on your gross income, which is the cash that you receive from other people. It's really how much of that is your profit.
Gotcha.
So I would say once your profit is roughly like $50,000, which, again, is, one of the same things for the S corporation, you want to start considering this as a potential strategy. And below that, sometimes unless you're already doing a lot of tax planning and things like that, sometimes the costs outweigh it. But if you're able to kind of, DIY it, then I would say go for it.
Gotcha. Okay, cool.
So also in New York, they do require quarterly estimated payments. And one of the key points of the pass-through entity tax is that you want to make all of those payments in the calendar year. Okay. So there's still a little bit, of discussion on this, because it is relatively new. But the idea is that because taxes, in most cases, they're going to be cash basis. So that means you only get the deduction when the money actually leaves your bank account. Gotcha. So we want to make sure that we're paying the pass-through entity tax in the current year. If it does leak over to the next year, that's not a big deal. It's just you have to wait until the following, you still get the credit on the current year, but you don't get the federal tax deduction until the following, So just making sure it all happens within that same calendar year. And then also New York, the same as the IRS, wants you to make those payments in 4 equal installments throughout the year. And then again, you want to make sure that you're taking a look at it, because you're going to have to pay New York and then also New York City separately.
Okay. So it kind of means that you need to have your financials like consistently being done to make sure? Because if it has to be an equal amount, how do you then calculate it usually then? If it has to be like an equal amount every quarter and fluctuation of income, is it kind of just like based off of what you did last year, then you add a certain percentage and then, okay.
Yeah, take a look at what you did last year. And then also, you should be forecasting what you think will happen this year. So you want to try to get as close as possible. And then also, in December, if there is anything that you need to pay a little bit additional, then you can just do that in December to kind of true it up. So yeah, it's just kind of making sure that you get all of those payments out to New York and New York City in time.
So making sure you do that first one for sure. And then doing them equally each quarter, putting those in, keeping your financials up to date so you can kind of keep that up to date.
Because, that's how you really determine how much that payment is going to be, because you have to take your profit. And then, so New York State is about 6.8%, 6.9%. And then New York City is another 3.9%. So you really kind of have to have an idea kind of where you're at right now, and then also forward looking. And because again, it's based on your profit, but I think there's ways that you can get to a general number, kind of take what your normal amount of expenses are that you claim each year, base that off of how much money you've received or what you expect to receive, and then use that as the number that you're going to calculate all of these percentages. But like you said, making sure that your financials are up to date. And then also, you want to make sure, especially towards the end of the year, that you're really communicating what that final income number is going to be, so that if there are any kind of larger payments, you can make sure to do that before the year is over, so that it can count on your federal tax return as a deduction for that year.
Do you have any I guess real life examples of just how, if we let's take a person or whatever and just how it all works, and then how it how they get the tax savings, how it then is reflected later, all fake numbers or whatever, but just kind of an example of how it all goes through?
So, really, I think one of the biggest things is making sure that the business owner has access to the business's New York online account, because sometimes that's the biggest thing. So I say January 1st, go into that, go into the account, make sure you have access, everything is good to go. Because sometimes you have your individual taxpayer, but you don't have the one that's linked to your actual business, and only the business can make that selection for you. So even though I am your tax accountant, I wouldn't be able to make that election necessarily on your behalf. It has to be out of your account that's specified for the business, because you are one of the officers and shareholders of the business. So making sure that that gets done. And like I said, you can do it in January. There's no reason to wait until March to make that decision, especially if you already know last year's numbers and you think this year is going to end up being pretty similar. So just kind of making that election. And then, like I said, you just take that, if you think that you're going to end up with $100,000 in profit by the end of the year, then you would just multiply that by your 6.9 and your 3.9%. That gives you the full amount that you'll pay for the year, then divide it by 4. And then those are going to be your quarterly estimated payments. And like I said, I normally, especially on the first and the second quarter, if you have the cash available, sometimes it's a little bit easier to overpay those ones, even if income fluctuates a little bit later through the year, because I'd rather pay a little bit extra in April and June and then have a lower payment in December or no payment in December because, a lot of other things are kind of going through. So, and then, like I said, once you complete all the payments, when you file your return, you're also making sure that that election is requested as you're filing the return. A lot of these, it has to be done on an original return. So if the tax preparer is not aware and they don't add that to your original return, even if they amend the return, it's sometimes not always available. So that's where the superseded return kind of comes into play and is a benefit. But it's really, really important that the person who is preparing your taxes knows about this and that you make sure that this is recorded. And then once that's done on the business return, if there is any over or under, they'll give you a refund or you'll make a small payment to them. And then when you get your K-1, you'll have, the income from the business, and it'll show your distributions for the year. And then it'll also show the credit that's available to you on the state level.
That's very cool.
And then when you file your state income tax return, kind of on that third page where it says how much you withheld from your W-2, what your estimated payments are, it'll also include this tax credit that's available to you. And in some cases, especially if you have a spouse who's working and has a W-2, then this income tax credit, the pass-through entity tax credit, kind of allows you to get a refund of what they've been withholding throughout the year. So, in some cases, you're able to either get a refund on the state level because of the withholding from other sources, or you don't really have anything to pay at that point in time.
That's very cool. Okay, so there's definitely some really good perks, but it's really all about setting it up and getting it in before that deadline to you want to participate.
And I mean, in 2026 now, because we have the new legislation, we also have to be a little bit careful because the federal government will only allow you to take the federal deduction if the pass-through entity tax payment is less than 102% of your overall tax payment. So if you have a short-term rental that's driving down your income, then you want to be a little bit careful because these percentages are kind of locked in.
Yeah.
So you have to pay the 6.9, you have to pay the 3.9, so if you have another source of income that would kind of drive your overall, your adjusted gross income down, then we need to take a look and see, do you still qualify for that federal tax deduction? And doing it that way. So just making sure that everybody is kind of aware of that bigger change in 2026. And then also, we have now the SALT cap is going to be up to $40,000. So, especially if you're looking at, maybe $20,000 in state and local income taxes, then you're still within the range to be able to itemize. So do you need to do this workaround for the pass-through entity tax? And I kind of say, because then you can still have your itemized deduction, but then this gives you an extra deduction on top of that. So instead of it all kind of, being included, especially if you're in a situation where you're getting the standard deduction. Because if you're getting the standard deduction, then it doesn't matter how much you're paying in state and local income taxes because you're taking that standard deduction. So now we're able to add that pass-through entity tax payment kind of on top of that standard deduction to give you a little bit more of the deduction there. So even though it may be a little bit of an extra step with the increased SALT cap and everything, it still most likely is going to be a viable option for business owners. And like I said, if you can make the exact same payment, but save a couple $1,000s by doing it in this weird way, by making the election by March 13th, doing quarterly estimated payments, which you would be doing anyways, in the amounts that you would be paying them anyways, but you get extra savings.
Why not have that benefit? Okay. So it seems like for the 2026 year, making sure that you are set up and then go talk to a tax accountant and get your plan kind of in place. But so just definitely making sure you have your access to the business account on the New York site, and then going ahead and doing that election.
Yep.
Okay.
And then just also keeping in mind, a lot of the states are going to have a similar program, but every state is going to have slightly different rules. So just really make sure that you're taking a look at those, and then
or talk to someone who specializes in it.
Right. So if you have any more questions about the New York pass-through entity tax, feel free to put a comment below or send us an email, and we are happy to talk through your particular situation.
Bye, guys.
Bye.
That's That's a wrap on Let's Get Fiscal. Ready to stop guessing and start saving? Click the link in the show notes, grab your consult, and let's make your business work for you, not the other way around. You've got this.